In 2007, during his second year on the job as chair of the U.S. Federal Reserve, Ben Bernanke was confronted with the worst financial crisis since the Great Depression. He chronicles his response in his new book. It's called The Courage to Act, a memoir of a crisis and its aftermath. And we welcome Ben Bernanke, the former Fed chairman, now an economist at the Brookings Institution, to TVO. It's great to meet you.
Good to be here.
Well, let's get you into what you are going to go down in history for, which is the way you and others handled the Great Recession. And here's an excerpt from the book. In all crises, there are those who act and those who fear to act. The Federal Reserve failed its first major test in the 1930s. Its leaders and the leaders of other central banks around the world remained passive in the face of ruinous deflation and financial collapse. The result was a global Great Depression. 75 years later, the Federal Reserve, the institution that I have dedicated the better part of my adult life to studying and serving, confronted similar challenges in the crisis of 2007 to 2009 and its aftermath. This time, we acted. Let's pick that apart. Starting with, if you had done nothing, what would have happened?
If we'd done nothing, the financial system would have collapsed. It would have brought the economy into a deep recession that might have lasted for many years. And without the monetary response that we gave, that would have been even a more extended recession. I learned from my work on the Great Depression, and the two mistakes the Fed made in the 1930s. First was to let the money supply collapse, not to do the right thing on the monetary side. And secondly, to let the banking system collapse, which destroyed credit and had huge effects on confidence. So we were determined to avoid both of those things. The first task was to avoid the collapse of the financial system, to intervene, prevent the crisis from getting completely out of control. And once the financial system was stabilized, we tried to use monetary policy to help the economy come back.
How deep into this thing did you realize we are not just dealing with a typical recession? This is something they're going to be studying in universities for 1,000 years to come.
Well, in 2007, there was already some signs of problems in the markets. And we were trying to weigh how severe it was. Was it more like 1929, or was it more like, say, the Russian debt default in the 1990s, which didn't turn out to be such a big deal for the U.S.? So we were making that judgment. By the end of 2007, beginning of 2008, it was clear that we had a very serious problem on our hands and that we would need to be aggressive to prevent even worse outcomes.
Did you ever have a moment where you said to yourself, this is so big, I'm not sure anything we do will work?
Oh, absolutely. The peak of the crisis was probably after the collapse of Lehman Brothers in September of 2008 and the bailout of AIG and all the events that followed that. And the financial system was in such chaos at that period, and we were hearing so many scary things from around the world in terms of economic activity, trade, that at that point I was very, very concerned about where things were going to end up.
Did you ever have a moment where you thought to yourself, I don't know what to do?
Well, I was never sure what to do, and we had to make decisions in a very chaotic environment under a lot of uncertainty. But I did have a framework, which is that I knew, again, from studying history, that central banks for hundreds of years have been equipped to deal with financial panics. And the way they do that, basically, is to make sure that financial institutions are able to fund themselves. So in a bank run, like in a 19th century bank run, depositors would run to the bank, pull out their cash, and the bank would fail. To stop that, central banks, like the Bank of England, for example, would lend cash to the bank so they would have the cash to pay off the depositors. Same kind of thing was happening in our panic in the United States, where banks and other financial institutions were losing their funding. The response to that is to be what's called a lender of last resort, which means that the central bank has to stand ready to make loans so that those banks can fund themselves. And so I understood that this was, in some ways, the classic response. It's what central banks have always done, but it had to take place in a very different institutional environment.
Here's another excerpt from the book. Toward the end of my tenure as chairman, I was asked what had surprised me the most about the financial crisis. The crisis, I said. I did not mean we missed entirely what was going on. We saw, albeit often imperfectly, most of the pieces of the puzzle, but we failed to understand, failed to imagine, might be a better phrase, how those pieces would fit together to produce a financial crisis that compared to and arguably surpassed the financial crisis that ushered in the Great Depression. Okay, what do you think you failed to imagine?
Well, people sometimes say, well, how could you not notice that house prices were really high? And how could you not notice that subprime mortgages were starting to go bad? We did notice that, of course. We understood that. And in fact, in 2005, when I was in the White House, I made a presentation to President Bush, and the presentation was, what would happen to our economy if house prices were to drop 30%? And the conclusion that my staff and I came up with was, well, it would cause a recession, but probably not a very deep one. And what I missed, and what almost basically everybody missed, was that the problems in the subprime mortgage market and in the housing market would trigger a financial panic, very much in spirit like the ones in the 19th century, but in a much more complex and globally integrated financial system that would itself be a huge danger to our economy. And it was the vulnerability of the financial system to that trigger that nobody really fully understood, including the institutions themselves.
Nobody? So nobody picked it up?
Well, I mean, I'm sure you can find somebody somewhere who made a, who said something.
Well,
I mean,
Rubino?
He had a few points that were relevant. That's right. So I don't want to. I guess I couldn't claim that nobody had any clue whatsoever. But I really think that having a comprehensive view of what was going on, just it wasn't out there.
So let me put you back in that time, and let's say you're at that meeting with then President Bush, and you say to him, you know what? I got a feeling the housing bubble is about to burst, and here are the dominoes that are going to fall thereafter. If he had said, Chairman, you're right, what do we do? What would you have done at that moment?
Well, if we're now in 2005, 2006, for example, I think that's awfully late. I guess I would have tried through the supervisors, the bank supervisors and regulators, tried to unwind some of the risky positions they were in and try and reduce the burden.
Would they have listened to you?
Well, they're supposed to listen to supervisors, but the fact is you need some cooperation because they're large, complicated organizations, and they outnumber the supervisors by many times.
Well, that's the thing. I mean, I can't remember his name now, but you quote somebody in the book saying, we know this party's going to end, but as long as the music's going, we're going to keep dancing.
Yeah, Chuck Prince of Citi, that's right.
Okay, so basically if you'd gone to them and said, you guys realize you're on the edge of a precipice, they would have said, hey, music's still going, sorry.
But again, one of the things that we were trying to do was to compare different risks. So for example, suppose that the crisis had been more like 1998, more like the Russian debt crisis than like 1929. And suppose that we had, in that situation, we had overreacted by really throwing everything we had at it. People would say, you overreacted. You're creating moral hazard in the markets by coming to the rescue, even though the system is, can manage it itself. So we were trying to, figure out how severe the problem was. It took a while to see that it was existential, that it was a threat to the entire system, at which point I think we became very aggressive and we took very strong action. But in the period running up to that, we were, realistically, we were trying to balance, how important was this risk? How dangerous is it? What about the risk of doing too much? What about other risks like the dollar and inflation and things of that sort? So, in real time, and this is one of the things I learned from writing the book, is going back and looking at my emails, looking at my memoranda and news clips and so on. In real time, the uncertainty is enormous, and you're in the fog of war, so to speak, and you're trying to balance the different risks. You never know for sure, and that was what made it extraordinarily difficult to figure out exactly at what point you really had to stop balancing the risk and go full bore.
Who do you think bears the largest chunk of responsibility for the fact that the economy and the financial architecture almost all went into the toilet?
Well, the Great Recession was the result of the financial panic. The financial panic was the responsibility, first of all, there has to be some responsibility at the doorstep of the financial firms themselves and the risks that they took and the fact that they didn't measure their risks and manage them in a sensible way. But secondly, the government, the Congress, which deregulated parts of the financial system, and the regulators, including the Fed, who didn't do everything that could have been done, one thinks, to prevent the panic from emerging in the first place. So it's unfortunately, people want to say, well, this person or that person. It was a very broad-based set of mistakes and problems and omissions, and the regulators and the Congress and the industry all bear, I think, substantial responsibility. And it was, again, the panic itself, which then led to the very deep recession.
Responsibility, but I'm not sure culpability, right? No one's gone to jail, no one's gotten charged. Is that a mistake?
Some people have gone to jail. There have been people who have been convicted of insider trading and market rigging and fraud and so on. Nobody has gone to jail in the upper levels of one of these firms or the regulators for that matter. And
Is that as it
I don't
should
know.
be?
I mean, I don't know. It's not a crime to be incompetent. It's not a crime to make a mistake necessarily. But one of the concerns I have, and I've talked about this a few times already, is I think that the way the Department of Justice responded to the problem was, I wonder about it, because what they did was they focused on fining big corporations. So many of the big banks would pay billions of dollars in fines to settle the problems with their mortgage lending, for example. And in doing that, in fining the corporations, and they're implicitly the shareholders, the Department of Justice was not necessarily investigating, who individually did what. And if clearly, everything that happened was done by some person. So, I'm not sure we got full disclosure on that because of the strategy that the Department of Justice took. Now, exactly what would have happened if they had investigated it? Would it be criminal? Would it be omission and commission? That's a question we don't know the answer to.
Some of the commentary afterwards, though, from some people in the private sector, I don't know, it seemed to me got a little intolerable. And the guy, I mean, I can't remember his name now, but the chairman of AIG, who's actually suing the government, suing the taxpayers for their spending $85 billion to bail him out of his pickle. I mean, do these people in the private sector know that the public sector, that the Mr. and Mrs. Average everyday American taxpayer saved their asses, and that they ought to maybe cool it a bit?
Well, you're not going to have any problem with me agreeing about that particular case. As you said, the government bailed out AIG because we felt that if AIG failed, it's the biggest insurance company in the world. We thought that if it failed, it could bring down the whole system. And then, after the fact, they sued the government, complaining that essentially we treated them too roughly. I agree with you. It doesn't make any sense. So I think some folks don't quite get it.
You did touch on this question in the book, so I'm going to ask you. And that is, I guess the first big legendary firm on Wall Street that got into trouble was Bear Stearns. And you, along with others, helped orchestrate a rescue for that outfit. Mm-hmm. Did you, unintentionally, I presume, encourage bad behavior among the rest of them by bailing out Bear Stearns?
Well, I talk about it in the book. I think it was necessary to do. At that time, there was a severe run on Bear Stearns. The money was flowing out. It was going to collapse. And we knew that if it collapsed, number one, we had no idea what other kinds of consequences there would be. We thought, for example, we actually did think that if Bear Stearns collapsed, that Lehman would immediately follow. And of course, Lehman did collapse later in that year. We were also very worried about the money markets, the market for repos, which is a short-term lending market, which is very important. People don't know much about it, but it's very important, and it could have had serious problems in terms of functioning if Bear Stearns had collapsed and people had lost money in that market. So we felt at the time that there really wasn't much of an option. So our strategy was to deal with this moral hazard problem that you're describing in two ways. One was to be tough on Bear Stearns. And Bear Stearns stock, a year in advance, a year before this event, was selling like for $172 a share.
For two?
And we told Jamie Dimon of JP Morgan that he could pay $2 a share. So clearly some punishment was going on. Now they ended up paying 10, but still that was much less than what it had been worth just a year earlier. So we tried to make the situation one, and again with AIG. AIG sued us because they said we were too tough on them. We took 80% of their equity and we took an 11% interest rate. So the first thing we did is we tried to be as tough as possible on the firms that we did have to prevent from failing. And then secondly, when looking at other firms, we tried to make sure that they were doing the right thing. So in case of Lehman, for example, Secretary Paulson and Tim Geithner at the New York Fed were on the phone with them all the time, putting on pressure, telling them to raise capital and to get their situation, fixed. And they did raise capital actually during the summer, but it just wasn't enough to deal with the problems that they already had. So we did try to address that problem. I think that if we had not intervened with Bear Stearns, we would have had September 08 would have happened in March 08. I think we would have had the same thing. At that point, it was too late to start making examples of people. At that point, we needed to prevent the system from collapsing.
And you don't think that when the Lehman people saw how you reacted to Bear Stearns, they thought, oh, okay, well, they'll come help us too?
Well, maybe they did. But again, the response was that Tim Geithner got on the phone, Hank Paulson got on the phone. We worked together with this SEC, the Securities and Exchange Commission, which was their nominal regulator, to investigate what was going on in that company and to pressure them to take appropriate action. So I'm not sure they could have done really that much different, under different circumstances.
Let me ask you about the size of the banks, because back then they were allegedly too big to fail, and that's when they had 25% of total bank assets, the big banks, and now they have 44%. And a few weeks ago, there was a guy named Robert Reich sitting in that chair, and Bill Clinton's former labor secretary had this to say about all of that. Roll it, please.
But the most important thing we should do is bust up the big banks. Any bank that is too big to fail is too big, period. Wall Street's allies will call it radical, but we've done it before. When the big oil trusts got too big in the early part of the 20th century, and the telephone monopoly later on, we used antitrust laws to break them up. The idea was to prevent too much economic and political power from concentrating in too few hands. And today it's happening all over again with Wall Street. The only sure way to stop excessive risk-taking on Wall Street, so you don't risk losing your job or your savings or your home, is to put an end to the excessive economic and political power of Wall Street by busting up the big banks.
Is he right?
I think is way too simplified. So for one thing, Lehman Brothers was a quarter the size of the big banks. It's not just size. It's the interconnection of the bank with other institutions. It's the role they play in the overall system. And I would point out that, in 1930s, when we had 25,000 small banks in the United States, we had a huge financial crisis and a Great Depression. So it's not any kind of guarantee. The trick is what you're trying to do is make sure the banks are safe. At the same time, you want to make sure that they can perform the functions that they do perform for the economy, to provide banking services for large multinational firms, for example, to deal with more sophisticated types of financial problems. So you want to have big and sophisticated institutions, but you want them to be, A, the right size to do what they have to do, and B, you want them to be safe, and in particular, you want to be able to let them fail. So there's too big, but there's also to fail. If you can arrange it so that a big bank can fail, then that problem is mitigated. And that was one of the major objectives of the reforms after the financial crisis, was to make sure that we would now have tools to help make sure that banks could fail. So a lot has been happening. For example, the biggest banks now have to hold a lot more capital, a lot more equity investment than they did before the crisis. And the biggest of the banks have to hold even more than other big banks, which makes them, A, safer, and B, it makes it more expensive to be a big bank. It makes them think about, should we reduce our size? We've seen that happen in the United States. A couple of firms, General Electric, for example, have broken up themselves because they wanted to avoid certain kinds of oversight and regulation. Now, so the first thing is to make them safer and provide some penalty for being too big, and to create an economic incentive for them to simplify. The other side of it, though, is to have the tools to allow a bank to fail. And Dodd-Frank regulatory reform includes a set of liquidation authorities, they're called. But basically, they're powers that the Fed and the FDIC have, so that if we had another Lehman Brothers, instead of letting it fail into bankruptcy and creating all the chaos it did, there would be a set of tools that allowed the Fed and the FDIC to unwind the firm much more safely. So a lot of progress is being made on this issue. I don't think that chopping up JP Morgan to 1,000 pieces is going to create 1,000 small JP Morgans. It just doesn't work that way.
Well, that's what I was going to ask you. You give me a Dodd-Frank, and I'm going to raise you a Glass-Steagall. Should we change those rules so that commercial banking and investment banking and mom and pop having their savings accounts in there are all done in separate institutions?
Well, I don't understand. So I'm all for tough regulation, and I think a lot of progress has been made. Let me emphasize that. I don't understand the interest in Glass-Steagall. What Glass-Steagall does is separate, as you say, separate the commercial banking activities like lending, making mortgage loans, from investment banking activities like investing in securities markets. So that's what Glass-Steagall would do. The point I would make is that if we had had Glass-Steagall in place in 2005, it wouldn't have done anything. It wouldn't have helped at all, because if you look at the institutions that got into trouble, with one or two exceptions, but if you look at the institutions that got into trouble, the banks got in trouble by making bad loans, and the investment banks got in trouble by making bad securities investments. So the fact that they were together wasn't really a major factor in any of this. So I'm all for good, strong regulation, but it should be aimed at a particular problem. And this particular one If anything, it would have made the situation worse because it would have prevented some of the banks from intervening to acquire the failing investment banks.
You know whose banks did okay during the Great Recession? Canada's.
Of course.
Do your banks need to be more like our banks?
Well, I have a lot of admiration for Canada's work in the Great Recession and in the crisis, the Great Financial Crisis. Canada, which by the way has only big banks and no small banks,
You're absolutely right.
didn't have the same kind of problem we had, and whether it's more conservative regulation or more conservative lending or some combination,
Or management, more
or better
conservative
conservative management, I'm not sure, but Canada did indeed avoid the kind of panic that we had in the U.S. and Europe. And by the way, more or less the same thing happened in the 1930s. When the U.S. had thousands of bank failures, Canada pretty much escaped that as well. So whatever you're doing, keep doing it.
Okay. Here's Joe Stiglitz writing in The Guardian a couple of months ago, in which he says wage stagnation also helps explain why statements from Fed officials that the economy has virtually returned to normal are met with derision. Perhaps that is true in the neighborhoods where the officials live, but with the bulk of the increase in income since the U.S. quote-unquote recovery began, going to the top 1% of earners, it is not true for most communities. I guess his point is the economy's recovered, but is it helping the right people? How do you see it?
Well, there's certainly a serious problem with inequality. There's certainly a serious problem that the recovery hasn't lifted all boats equally. It's certainly helped some others more than others. But this is not something the Fed really can do that much about. This is something that's been around since the 70s or the early 80s. So we've had these very long-term trends to increased inequality. They arise from a whole variety of sources like globalization and technological change. The Fed, what the Fed can do is help return the overall labor market back to something close to normal. And right now in the United States, unemployment is 5%, which is below historical averages, and it may fall further. So what the Fed can do is try and get that unemployment rate back to a more normal level and try and get the labor market overall back to a more normal level. The Fed has very little ability to distribute income from rich to poor or any other way. If you're going to have something like that, that's where the Congress has to come in, where fiscal policymakers have to play a role, or other policymakers. The Fed basically is just trying to get the economy back to full employment, and we've made a lot of progress on that.
Are you more or less optimistic about the state of the international economy today?
Well, right now, the United States economy, the domestic economy, is actually pretty strong. You're seeing a lot of strength in household spending, in automobile sales, in housing. Government spending has become a more neutral factor. So the U.S. economy at home is pretty solid right now. But the main drag that we're seeing is, in fact, from the international economy, from China, which in turn, the slowdown in China has in turn created stress on emerging market economies. And also economies like Canada, which are exporters of commodities. And it's the slowing of the global economy, which is probably the biggest headwind to U.S. continued recovery. And that's where, I know the Fed is trying to balance those different forces.
We got a minute left, and I want to finish on something a little more personal, if I can.
Sure.
You're a baseball fan.
Absolutely.
Okay. I wanted to ask you a question that I'm pretty sure no one else is going to ask you in all the interviews that you're going to be doing. Who was the most valuable player in the National League in 1963?
1963, Frank Robinson? No.
Guess again. I'll give you a second guess because we're Canadian and we're very genial. Think number 32. Think your favorite team.
My favorite team, Boston Red Sox, Washington Nationals?
Okay, back in the day.
Back in the day.
Back in the day.
32, Sandy Koufax.
There you go.
There you go, right, absolutely. Sorry about that. It's unusual. The reason I had trouble, it's unusual for a pitcher to be most valuable player.
Correct.
But he had a terrific season that year.
It was one of those years where I think everybody who was the MVP in the American League, National League, NFL, and Canadian Football League all wore number 32.
Wow.
That's something you can tell you.
O.J. Simpson or somebody.
It wasn't O.J. No, it was, let me think, it was Jim Brown in the NFL, it was Cookie Gilchrist in the CFL, and it was Elston Howard for the Yankees in the American League.
Well, numerology works, I guess.
There you go. There you go. It's one of
Okay.
those quirky things. Mr. Bernanke, it's awfully good of you to spend some time with us here at TVO. Go Red Sox. I'm with you on that one.
Okay, thank you.
Help TVO create a better world through the power of learning. Visit supporttvo.org and make a tax-deductible donation today.